Okay, let's dive into this. Welcome to today's explainer, where we're putting Cogent Communications through an absolute investment gauntlet. As investors, we're always hunting for the truth, and the markets love throwing us these incredibly complex puzzles. Well, Cogent is exactly that kind of puzzle. Today, we're going to strip away all the market noise and run this stock through the uncompromising lenses of history's absolute greatest financial minds to see if it can actually survive the test. Here's our roadmap for this explainer. First, we'll grab a quick snapshot of the company. Then, we'll systematically pass the stock through the frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll crunch the quantitative math with a DCF, and finally, we'll pull it all together for a data-driven final verdict. Section 1. Cogent Company Snapshot, a mixed reality. We really need to set the stage here because Cogent exists in this fascinating state of mixed reality. On one hand, it's an absolute titan of the internet infrastructure world. But on the other hand, its financials tell a story of, well, a lot of recent friction. Let's look at the raw data derived from our sources. The ticker is COCI, currently trading right around $9.98. At its core, Cogent is a Tier 1 internet service provider, and their scale is honestly staggering. They carry roughly 25% of all global internet traffic. But here's where we hit that friction I mentioned. Q2 2026 service revenue came in at $235.6 million. That's actually a sequential decline from the previous quarter, largely driven by the runoff from their recent acquisition of the Sprint wireline business. Now, they did post an adjusted EPS of $1.39 for the quarter and $71.1 million in EBITDA. But, and this is a big but, they are carrying a massive debt load. We're talking a 6.23 times net leverage ratio.
Section 2. The Buffett Lens, Qualitative Business Economics.
With that groundwork laid out, let's evaluate this stock using Warren Buffett's framework. As you know, Buffett doesn't just buy stocks, right? He buys businesses. His famous checklist is rigorous. He demands a wide economic moat to fend off competitors, consistent, predictable earnings, a high return on equity, and absolutely manageable debt. Plus, he insists on honest, transparent management. Only if a company passes all these tests will he even bother calculating an intrinsic value, and you better believe he demands a margin of safety before buying.
Interestingly enough, on the management front, Buffett would actually find something to like here. When asked about that complex Sprint wireline acquisition, CEO Dave Sheffer didn't try to sugarcoat the ongoing revenue declines or the slower-than-expected wavelength ramp-up. He just openly graded the company's execution a B. He acknowledged that while they exceeded their cost-cutting targets, top-line stabilization just fell behind initial expectations. Honestly, that is exactly the kind of radical candor Buffett looks for in a management team.
Now, what's really interesting about this slide is how the rest of Buffett's checklist plays out. Cogent's infrastructure moat, undeniably wide. Handling a quarter of the world's web traffic is a massive, massive barrier to entry. So, moat gets a pass. Management gets a pass. But financially, it gets pretty ugly for the Oracle of Omaha. Earnings have been declining for multiple quarters because of that Sprint runoff. Return on equity is an automatic fail because Cogent currently operates with negative equity, specifically a $34.1 million stockholders deficit. And that debt load we talked about, at over 6 times net leverage, Buffett would take one look at that balance sheet and just immediately reject it.
Because of all that high debt and the negative equity, a strict Buffett approach would view this business as highly leveraged and incredibly risky. To compensate for that risk, if he were to calculate an owner earnings valuation, he'd require an enormous margin of safety. Our analysis suggests his hypothetical target buy price would be dragged down significantly, likely landing somewhere around $7.50. That's well below current trading levels, just to justify taking on that balance sheet risk.
Section 3. The Lynch Lens, Categorization and Growth. Let's shift our perspective over to Peter Lynch's framework. Lynch's whole strategy starts with categorizing the company so you can set realistic expectations for your investment timeline. Are we looking at a fast grower, a stalwart, or maybe a turnaround? From there, he wants a low PEG ratio to ensure you aren't overpaying for growth. He also demands a strong balance sheet, and he loves to see positive signals like insider buying or low institutional ownership.
When we apply Lynch's factors to Cogent, the categorization is crystal clear. This is a turnaround play. Look, they had 18 consecutive years of organic growth before the Sprint acquisition triggered 3 years of top-line declines. Management is actively trying to turn this massive ship around right now. However, Lynch demands a strong balance sheet for turnarounds, and Cogent's $1.97 billion in net debt makes this a very weak balance sheet by his standards. And while management is targeting long-term growth of 6 to 8%, those numbers just aren't materializing in the top line quite yet. Without clear positive indicators like insider buying to offset these risks, the picture remains pretty murky.
Because of all that, Peter Lynch's likely verdict would be a definitive hold. For a turnaround story to actually trigger a buy signal in his book, the bleeding has to stop. Top-line growth must demonstrably return to offset the sheer weakness of the balance sheet, and Cogent just isn't quite there yet.
Section 4. The Graham Lens, Rigid Defensive Value.
All right, brace yourselves, because we are now entering the most unforgiving stage of our gauntlet. Benjamin Graham, the legendary father of value investing, relies on a rigid, mathematically driven defensive checklist that leaves absolutely zero room for emotion. His criteria are incredibly strict. He wants adequate size, a rock-solid financial condition where current assets are double current liabilities, a long history of uninterrupted earnings and dividends, and very moderate price-to-earnings and price-to-book multiples. All of this culminates in his famous intrinsic value formula, the square root of 22.5 multiplied by earnings per share multiplied by book value per share.
So the crucial point here is how we handle Cogent's balance sheet within Graham's math. As we noted earlier, Cogent has a stockholders' deficit of $34.1 million. That means they have negative equity. Now, mathematically, you literally cannot calculate a price-to-book ratio or take the square root of a negative book value in Graham's formula without totally breaking your calculator. Therefore, to even evaluate the company, we have to assume a capped book value per share of $0.
And when we run his checklist, it's an absolute bloodbath. Cogent passes on adequate size and recent earnings stability. They also technically pass on dividend history, having paid out for 13 years. But that comes with a massive asterisk, because that dividend was recently slashed from nearly $1 a quarter all the way down to just 2 cents. But where they spectacularly fail is the financial condition test, since total debt vastly exceeds equity. And naturally, with negative equity, they fail the price-to-book ratio test entirely.
So, when you plug a book value per share of 0 into Benjamin Graham's intrinsic value formula, your result is exactly 0. A strict defensive Graham investor simply wouldn't touch a company with negative equity and this much leverage. For Graham, Cogent is essentially uninvestable until that balance sheet gets repaired.
Section 5. DCF and Alternative Models, the Quantitative Math.
Let's step away from the philosophical frameworks of our gurus for a minute and look purely at the quantitative math, starting with a discounted cash flow valuation. To build a forward-looking DCF, we have to make some standardized assumptions to fill in the gaps. We're going to model forecasted free cash flows by giving management the benefit of the doubt on their 6% long-term growth target as the Sprint runoff finally stabilizes. We'll discount those cash flows back to today using a weighted average cost of capital, or WACC, of 9%, which is standard for telecom, and we'll apply a perpetual terminal growth rate of 2%, essentially roughly pacing inflation. And this brilliantly illustrates just how sensitive the valuation is to our assumptions. If you look at the center of our sensitivity table, at a 9% WACC and a 2% terminal growth rate, the base case fair value lands at $12.30 per share. What this implies is that if management executes their turnaround perfectly and actually hits that 6% growth target, the stock is currently slightly undervalued at $10. But if their cost of capital even inches up to 10%, the fair value drops right back down below $10.
When we check our work with alternative models, the challenges are still right there. A dividend discount model, for instance, relies entirely on cash return to shareholders. Because Cogent slashed its dividend by over 97% down to just 2 cents a quarter, the DDM spits out an incredibly pessimistic valuation. Conversely, if we look at a comparable EV to EBITDA multiple, Cogent's strong $71.1 million quarterly EBITDA run rate suggests a highly valuable enterprise. But remember, enterprise value includes debt. When you subtract that massive $2 billion debt load to find the actual value of the equity, the share price valuation gets compressed significantly.
Section 6. Synthesis and Final Verdict. Surviving the Gauntlet.
Let's move to the synthesis and see how this builds into our final conclusion. We've run the qualitative tests, we've run the turnaround logic, we've done the rigid value formulas, and we've modeled out the future cash flows. Here is the master summary of our investment gauntlet. The Buffett lens suggests a target around $7.50, demanding a huge safety margin to account for that debt risk. The Lynch lens dictates a hold while we wait for this turnaround to actually start showing revenue growth. The Graham lens outright rejects the stock at $0 due to the negative equity. Only the DCF model shows some optimism at $12.30, but remember, that relies heavily on management executing a virtually flawless future growth strategy.
Blending all of these insights against the current price of roughly $9.98, the data-driven, mathematically prudent final recommendation is a definitive hold. The severe risks on the balance sheet currently neutralize the undeniable scale of their infrastructure.
Which brings us to the ultimate question you have to ask yourself as an investor looking at Cogent. They own an incredibly wide economic moat, literally providing the plumbing for a quarter of the entire world's internet, which is huge, especially as AI data demands explode. Yet they are choked by legacy debt and acquisition hangovers. So I leave you with this. Can a company carrying 25% of global internet traffic ever truly be a value trap? Or is this just the darkest hour before the turnaround finally takes hold? That's the puzzle you have to solve. Thanks for joining me on this explainer, and keep learning.